a job that you bid 50,000 and the time comes in at 75,000 and you go back to the client, you're not going to get that full 25,000.
Ira Rosenbloom spent 15 years as managing partner of a 40-person CPA firm, tripling its revenue before successfully merging it with a top regional firm. Now he helps other firm owners do the same.
Accountants work very, very hard. They tend to be extremely dedicated to their clientele. Sometimes they treat their clients as family when it comes to their billing structure. That is not the best way to be profitable. I haven't said anything in this conversation about raising the fee. It's all about using your time wisely.
If you're running an accounting firm and wondering how to elevate your growth, increase profitability, and map out your succession plan, then this conversation is for you. Welcome to the Growing Your Firm podcast. Hey everybody, David Cristello here, founder and CEO of Jetpack Workflow, host of Growing Your Firm podcast, and co-founder in Actually Finance. I'm really excited to have the guest today. He's Ira Rosenbloom. He's the CEO at Optimum Strategies. He calls himself the Merger and Profitability Optimizer. So you can imagine we might hop around a lot of opportunities, small to mid-sized accounting firms have around profitability, M&A. One area we really kind of lit up pre-interview was succession planning. You have this perfect person that one day walks out the door and, oh my gosh, what are you going to do? So we're going to unpack how to future-proof some of your succession planning, and I imagine so much more. But first off, Ira, welcome to the show.
David, it's great to be with you. Thank you for the opportunity.
Absolutely. So I know I gave you a kind of a high-level overview of Optimum Strategies, but for folks not familiar with your work, what's 1 to 2 sentences about what you do and who you do it for?
So I concentrate heavily in the succession arena. I would say at this point it's 75% of my focus and my team's focus. There's 5 other people who work along with me, and our meat and potatoes is working with firms that have anywhere between 15 and 150 people. On the smaller side, they're not typically doing the acquiring. They're the ones who are being acquired. However, there are those unicorns who view themselves, and they are correct, as being in a very good position to add on, and then they become more of a force in their market. So I spend 75% of my time helping people figure out, what's the right answer for them. And sometimes they're correct that they should pursue a merger, but they need some time to get their act together, to put it in street talk. And then the other 25% of my time is spent helping firms actualize the profitability that they're entitled to. Accountants work very, very hard. They tend to be extremely dedicated to their clientele, and sometimes they treat their clients as family in more than just being attentive, but they treat them as family when it comes to their billing structure. And that is not the best way to be profitable, but being profitable is about much more than just your fees. There's a whole bunch of things that impact your profitability. Even if you are charging market rate fees, there's still a lot of things that can be done to enhance profitability. And profitability is an issue that I see for firms of all sizes. While firms of all sizes may not be merger candidates, and firms of all sizes tend to have succession dilemmas, profitability is something that is always something that can be enhanced. And once you open people's eyes to it, they have that aha moment and they don't turn back. It's like, oh my God, we found something that we believe is perfection. It's heaven. So it's really exciting when you get there.
Yeah, I know I mentioned succession. We're going to get there because I love this idea of like, what do you want? And then step 2, let's get your act together so you can get what you want. But profitability always struck me as, or at least historically, a lot of our interviews is like, shouting at the rooftops, raise your prices, or go from hourly to fixed or fixed to value. It's all, some way of jacking up the price. You're saying there's more than that than fees. So I'd love to spend a couple minutes what are the other variables when everyone else is saying, and I'm sure you're saying, yeah, you got to increase your prices, or you have these legacy clients that are getting a 50% discount. Come on, we got to do something about them. But what else in your mind are the key components of profitability, and or what are the ones that most people ignore when they're just so consumed with thinking about price increases?
All right, so a couple of things that are just astonishing to the CPA firm when I dig in with them. I typically start off by asking them to sort through their fees so I could understand what amount of volume and what percentage of their work comes from fees that are within certain tiers. Depending upon the size of the firm, I typically will start with 5,000 being the low number and then going up by 10,000, and more often than not, in the smaller firm, 100,000 and above. In a larger firm, I could ask them, do you have clients that pay you $250,000? And what I find is the CPA firm is amazed at how that bandwidth's set up. They have very, very poor grasp on the fact that they're doing too many small accounts, and they're taking so much of their time and focusing on the low end, not saying anything about quality. Some of those $3,500 clients may be outstanding people and wonderful clients, but that's not the best way to use your time. So the goal is to have them work in a way that they're at their highest and best use. And how can you elevate the concentration towards meatier clients and therefore potentially keep your volume the same, but certainly preferably grow it, but work on less clients so that the more model clients you have, the more clients you have that you do well with, then the more profitability is going to come out of it, and the happier people are going to be, both clients and staff. And so the motivation is there, the efficiency and the excitement is there. So you tend to take that client, and now cross-selling becomes much easier, where if you're a partner and you have to manage 200 clients, it's not as simple to do a cross-sell if you have 100 clients in front of you. And that really impacts significantly in the profitability side. I haven't said anything in this conversation about raising the fee. It's all about using your time wisely. And then the other area, which is a huge trap, is scope creep, where folks are, they state the right kind of hourly rates and they have a sense of value, but the communication is so poor between the staff and the partner that they're not going after and stopping the scope creep. And so therefore at the end, where you had a job that you bid 50,000 you thought was going to be even above market, and the time comes in at 75,000 and you go back to the client, you're not going to get that full 25,000. But if somebody had said something while you were going, there's a good chance you would have come close to that 75,000, or the client would have done the extra work themselves, which might have been even better. And so these are notorious areas that just get no or poor attention, and they are big impediments to profitability. This is rampant in the industry. Both of these elements, not knowing what you really do best and not putting a discipline in place to prevent what I'll call leakage, to prevent just poor judgment.
But how do you install or instill the scope creep, I guess, behaviors so people do flag it? Like what do you recommend firms start doing? What is you said there's a communication breakdown between the staff and the partners. How do you fix that? How does scope creep start getting surfaced?
I think there's several things you could do, and believe me, it's not perfect, but it can be something that you can make great strides with. Number one, there are time management systems where you can input the budget, and you can have a notification go out when you've hit 80% of the fee or 50% of the fee, Now, if the partner's not paying attention to it, or the billing manager's not paying attention to it, we have a fundamental crisis over there. That speaks to other problems going on in that person's life in terms of their billing behavior. But that is a really excellent core approach where you can get that budget in there, and then you get a notification and somebody can say, what's going on? Are we going to come in at budget? Where are the problems coming from? So that's a mechanical device. The other thing that I know works very well is when you incentivize your staff to come forward so that they get part of the economic benefit by the write-down not being there, or they get some of the economic benefit by the margin being there. That tends to be a very good method because the staff is going to be more aware of it than the partner is, unless it's a sole proprietor who's doing everything nearly on their own, and that's a different conversation. But if you're talking about a firm of 15 to 150 people, it's going to be the staff who are going to be the front guard on that. And if you incentivize them, and there are different ways to do it, but ultimately it does relate to compensation, you're going to get a change in culture and a change in behavior. And by the way, the buck stops on the partner's desk. So you could have a staff person come in here and say, hey, they want us to do X, Y, and Z. It wasn't in the deal. Okay, we didn't budget for that, and now it's going to set us back. And the partner may say, thanks for letting me know, I'll take care of it. And he or she does nothing. So that's also a problem that the managing partner or the executive committee has to get their arms around, because they're going to risk losing that staff person when that partner didn't play by the rules that the firm wanted. And that is the most painful result that can be, losing top-notch people. And that's where the partner's attention is grabbed. Because you could have some partners who, they're at a point in life that the next $10,000 or $15,000 doesn't mean enough to them, or they have a spouse who's making a significant amount. But losing a team member, that means a lot to them. And we live in a world where this is a very, very radical situation. There's just not enough people wanting to stay in the profession, and not enough people who have a particular passion that aligns to the views of leadership. It doesn't mean it's not a good passion. It just means there's a disconnect. So the possibility of losing somebody, that is a very big motivation. But that's where you have to have a strong managing partner, a strong leadership group to really get that message out there and say, look, I get it. You don't want to do this. We don't want to lose Johnny. If we lose Johnny, we may go a year without finding a replacement.
Mm-hmm. What are some examples of these incentives? You said that you can kind of slice them a few different ways. I guess just to help folks understand, in order to get the team aligned. I love, by the way, of course, with Jetpack, being a software vendor, I love the idea, time tracking, look at budget via actuals, get alerts, if something goes beyond a threshold, review these things. I love this. It's very similar to, obviously, if you're in a general ledger and there's, something happens at a transaction level or an expense level. I love these kind of warning systems. But I also like the idea of, the incentive drives behavior. So I love a specific example of the incentive structure somebody could receive, for identifying scope creep.
Okay, so I think there's a mix here. You could go with something very black and white and say, look, every time you bring to our attention that we are now at the max or there's extra work, we're going to give you a percentage of that extra work, whether it's 5%, 10%, whatever it is, because you were a great soldier. You brought it to us, and that's certainly black and white. It may not be the easiest thing to track, but in your software, maybe you'll figure out how to track it. But in a smaller firm, word of mouth goes a long way. So 15 to 25 people know, and they really rally around it. So that's a black and white process. I think the healthier process is to recognize that the firm is not one situation, it's a bunch of situations. So you would look at every staff person and their responsibilities and say for the tax season or for the year, what did they do overall in the way of capturing opportunity? And that opportunity could be scope creep. That opportunity could be new business, in other words, cross-selling. That opportunity may also be involved with, hey, we did the job the way you budgeted to be. And there was no scope creep. And yet we came in and we're at 80% of standard. That's the totality of, you can't just reward somebody. You've got to also have the penalty involved. And then you look at it at the end of the year and say, look, in totality, if I take those write-downs that he or she was responsible for because they were the ones who created the budget and there was no scope creep, and I take all these other things, then I meld it together and I give them a percentage of that. I think that's a more realistic picture because life is not just about riding the slide up. There's going to be some moments where you're stuck.
Yeah, I love that. I love that. If you're still managing recurring client work with spreadsheets, checklists, or disconnected tools, it's time to look at Jetpack Workflow. Jetpack Workflow helps accounting and bookkeeping firms organize deadlines, standardize processes, and see exactly what's due across every client, so nothing falls through the cracks. Thousands of firms have used Jetpack Workflow to streamline operations and gain confidence that work is getting done on time, every time. Visit jetpackworkflow.com to schedule a demo and see how your firm can get more organized today. I can continue to talk about profitability probably for the whole length of the interview, but promise at the top, and we talked about it, succession planning. I mean, it feels like it's such a fragile time to be reliant on we'll call it an underdeveloped succession plan. And so what I mean by that is, I have my number two, Bill or Lisa, whoever, right? They've been working for me for 10 years, 15 years. They are the person that's going to take over. They've shown interest in it. And you know what? If they walk out the door and they start their own firm, or somebody dangles a big carrot, all this private equity money comes in, and they say, hey, well, we're going to give you a big salary bump if you come here, and we'll give you equity right away. There's all these new offers coming in. AI is allowing for people to launch firms faster, maybe grow quicker, sooner. And so there's a lot of competition to potentially, quote unquote, take away your succession plan. So I'd like to take a step back and say, you kind of broke into these two components. First, what do you want? Do you want it to be a person, or do you want it to sell it outright to a group, and then get your act together? So let's start with the first one. How do you help partners, owners identify what in the world they want to do in the first place?
Well, I like to have a mini retreat with the ownership group because not everybody's going to see eye to eye on this. Ideally, they will see all eye to eye on it, but you tend to have some type of generational dispersion. So let's take a 3 or 4 partner firm. You're likely to have 2 partners in their 60s and 1 partner in their 50s and another partner in their 40s. Unfortunately, they don't have that 30-year-old yet. And that's where they're saying, well, we think it's going to be Billy and we think it's going to be Jenny, whoever it's going to be. But think isn't as much an encouraging factor as knowing. And that is a fundamental issue in that they really don't know these people. And they have to get a deep understanding of what makes somebody tick, and they have to recognize that the world has changed. They're really good about all my technology. Now I got to use AI, and I had to go from VisiCalc to Excel to all these other programs, but they don't hone in enough on how people's mindsets and behavior have changed. They read a book, but they don't think it applies to them. So they need to really understand from the Billies and the Jennies of the world, what would being a partner mean for you? What would excite you? What would turn you off? And they themselves have to say, what do we expect of a partner, period? We need to sit back and say, are our expectations in line of where the reality is? And that's this conversation that I have. When I hear from the leadership group that they're looking for certain things, I'll sit back and say, wow, I think that if you were talking to me in 1998, you would be right on point, except you're talking to me in 2025 and 2026. That's not what the world looks like today. And then you negotiate amongst them, and at some point, you could see that they don't have the energy and the passion to get where they need to be. And then you open up that conversation. Look, guys, you could spend 2 years trying to do this, and maybe you'll get to where you want. Are you open-minded to talk to somebody else who's built a program? They can go to Billy and Jenny and the Billy from the generation that's going to come up the pipeline, and they know how to do these conversations. They know how to find out what hums. Are you ready for that? And that's sometimes really the right answer. Other folks will struggle with it, and they'll say, oh, no, we could do anything. Yeah, let's do that. So then I've got to spend time with the Billies and the Jennies of the world and really understand what they would expect out of this situation. And what you come away from is that there is a potential for an alliance, but the alliance has to take shape in a very different way. And it's an intimidating road forward for these people who have yet to say yes. They see the responsibility of being a partner as the behavior pattern of that 60-year-old and that 50-year-old, which, at least for the 60-year-old, they don't have much of a life outside of that office. They take summers off, they are away for Christmas, but otherwise they're like, tied to the desk. Mm-hmm. And these people say, I know that if I don't do that, they're going to treat me as an outsider, and I'm going to make an economic investment, and I'm just going to be miserable. And so they're taking their definition from a picture. And I understand a picture's worth 1,000 words, but the leadership group has to come back and say, look, this is my generation. I don't expect you to be me, but I do expect you to take care of these 10 clients. I expect this to be the case, and to define it very, very differently than it was defined, and probably never defined. But what was the behavior pattern that the 60-some-odd-year-old observed and accepted? These 30-year-olds do not accept it. They observe it. And this is a really big reason why those 30-year-olds don't say yes, because they see that they have to conform to something that is not natural for them. And you spoke earlier about technology. This is where it's an extremely interesting conflict, because the older generation knows that the technology is important, and they know that the younger generation will be the one to embrace it and lead the way, but they can't get out of their own way to empower them to do it and let that younger person know that the expectations won't be so insane that, we're going to empower you. You could do that from 10 o'clock at night until 2 o'clock in the morning, but, you can't do this empowerment during the regular day. And that's where they really shoot themselves in the leg.
So what, it sounds like there's this, your quote unquote succession plan could walk out the door, and that's because they don't want to adhere to the same, for lack of a better word, lifestyle, I suppose, that the retiring partners feel like is required to not only keep the business afloat, but to make the firm successful. So you say, well, this is what hard work looks like. This is what makes the firm grow. This is how you take care of clients. And then you have the 30s and 40-year-olds saying, I hear that, but it's not for me. So if that's what's required, that's fine. Just tell me, and I'll probably set up my own shop. In which case, and some of the people we've interviewed go out and set up their own shop. I mean, it happens. It happens very frequently. So, obviously and both parties might walk away a little disgruntled for it. But all that to say, now the partners are like, well, there goes the succession plan. There goes plan A. But for the firms that have navigated this successfully, I mean, is it really, unfortunately, a matter of compromise of like you said, is it articulating that there's not an expectation for them to work? I mean, I hate to say it this way, like work as hard as they did. Like, I mean, I can't, like, Would partners even say that? It's kind of crazy to say out loud. I imagine a lot of partners were like, I'd rather sell. Right?
The partners and the leaders of that generation, the baby boomers, need to convey that the standard of excellence must be there.
Yeah.
But the methodology is expected to be different. Expected to be different. That's a hard thing for them to say, but at the end of the day,
yeah,
they want happy clients. And if your method can make them happy, wonderful. I don't want to hear that we have unhappy clients. Now, the fact of the matter is that these people who are potential partners have been taking good care of the clients, but the partner has been consuming a very big liaisonship. And I think this is another fundamental issue where early in the career of a professional, the partners must empower the staff and the senior and the manager to take on that liaisonship, to really take ownership of the client, that it's their client and the partner has a role. It's a true team. It is not, this is Bob's client and I got to do it Bob's way. No. We're a team. It's a firm client. And the client knows when to reach out to Bob, the partner, because there's something that, is totally within that person's wheelhouse. But there's a failure in many cases to generate the relationship and therefore the excitement between the younger people and the client so that there can be this new definition and the leadership group can be confident and say, you know what? I'm really confident that your way is going to work because you've been using it for the last 3 years and I don't get any complaints. As a matter of fact, I get compliments.
Well, yes. It's a good default understanding. In this fictional scenario, the only reason you're getting considered for a partnership track, I would like to believe, is because you are exceptional. You are great with the clients. You are great across the firm. And yes, you might work differently, but from the partner level, it's like, well, he or she gets results. I mean, the clients love him or her. They buy more from him or her. They give us great testimonials and review. Word of mouth is great. So there should be exhibiting characteristics of, like you said, the standard is the standard. We're not decreasing our level of excellence or quality, but we understand that insert name, is not going to have the exact same playbook that we do. But that's how the firm stays relevant and survives and things like that. So I mean, but then on the flip side, if I'm a partner and I'm listening to this, I'm like, so what? We just cave in all the time to to like their way, do you ever have to deal with these emotional reactions, which is I feel like I'm caving into this. Yeah.
This process is heavily emotionally driven. Number one, when they come to the decision that they should merge up, it's because they can't take it anymore. And their emotions and their family life has really been impacted by it. So, number one, there's definitely emotion when they are definitely driven to merge up. Number two...
You say merge up, what do you mean by that?
In other words, a firm sits back and says, look, we got Jimmy and Benny, and they're really good people, but we're 5 leaders. We only have 2 of them. They're great, but 2 of them can't replace 5 of us. So we're going to have to merge up and do something. Jimmy and Jenny or whoever they may be all on board with this. They may love it too. They may say, hey, it will be much more difficult for... One of the reasons we said no is because we figured we were going to have to work for 5 people instead of work for 2. And this is why it's important to have an outside facilitator to come in and understand what's in the mindset of those 2 people and bring it towards the partner group. So does the partner have to be compromising? Whatever the partners do, they have to be ready to compromise. Because if they did merge up, the larger firm isn't going to say, you know what? Continue doing everything the way you were doing it. You were brilliant people. You want to use your software, use your software. You want to keep your firm there. That doesn't happen. They will take some of their better ideas, but there's going to be compromise all over the place. Do you see the ROI on that compromise to be better than the ROI on the compromise with your internal team? That's a different conversation, but there's going to be compromise all over the place. And the majority of the conversations that I have at the beginning is, we would prefer to transition internally. It's a more comfortable place for us to go. And so, can you help us make a go of it? How much time does it take for us to evaluate that? That's the majority. There are folks who don't have their Jimmies and Jennies, and they know they've got to do something, but a lot of them would prefer to test the waters internally and also create different types of collaborations so that they aren't as dependent on their basic work product. So, can we collaborate with an HR firm? Can we collaborate on financial services? And maybe we'll make more money, but we'll work actually less. And we're less dependent on finding CPAs who are harder to find. And now we can bring in people from different walks of life. And I think that is also one of the crucial, exciting elements to perpetuating the independence of a firm, is to look at it in the fashion that PE has looked at it, because they had no choice. They have to create an alternative practice structure, because you can't issue a financial statement unless you're a CPA. So they have a CPA firm, a tax firm, and an advisory firm. Well, a small firm can do the same thing. And if you did that, maybe you're going to take in some people who are really brilliant people who can really run a business maybe better than a CPA can, and you're going to have a much more exciting business, and you're not going to be as in the competition in the same way as, okay, now I'm competing with a 300-person CPA firm. Oh, no, you're not. You're now a financial services boutique, and you're competing with a leg up on many others. That's a very different approach, and that's one where I think more traction has to come, and younger people are going to like that because they like to be involved with challenge. Are there young people who like compliance? There's no question about it. But are there more and more people who like intricacies, who have been brought up on algorithms and multitasking? Yeah. Well, you're going to do a lot more of that on the advisory side than you are on ticking and tying and things along those lines. Not to diminish the importance of ticking and tying. It's a very different methodology.
Hey, David here. Thanks so much for checking out this episode. Did you know that we run the Growing Your Firm newsletter, where we not only publish upcoming podcasts and episodes, but it's where you get invited to the summits that we hold multiple times a year. These are virtual summits. They are free. And we do things like the AI Summit, the Advisory Summit, the M&A Summit. Go to jetpackworkflow.com, click that Learn button, and make sure you sign up for the Growing Your Firm newsletter. Yeah. Well, you bring up PE. I guess as it pertains to succession planning, that really felt like it was, I don't know, 5 years ago or so. That is what you do. That is the thing. You have the baton, you pass the baton on to the next generation, and that's what happens with most firms. I mean, of course, they would be sold and others would buy, but PE's kind of blown open the door. And so, have you seen, or to what effect has PE impacted succession planning? Because it feels like there's a carrot dangling. There's the hard work of compromise and dealing with emotions and soft skills and what people want. Oh, it's just so squishy and aggravating, and it keeps you up at night. Then there's the dangle of PE. So have a lot of people just said, like, I don't want to deal with all this mud and craziness and compromise. I want to go the PE. Has that been the case, or what have you seen the impact of PE?
Well, again, it's not a simple answer, but I'll try to make it simple to relay. One, if it's a firm that is dominated by baby boomers who are very close to retirement, they're 2 to 3 years away from retirement, PE might be the best thing that ever happened to them, because they really don't have to concentrate on what could go wrong. They concentrate on how quickly will the money be in my bank account. And because cash is a considerable part, especially up front. And so for those people in that generation, it's an enticing opportunity. The challenge comes about when you have this multi-generational partner group, and they have partners in their 40s and maybe partners in their late 30s who sit there and say, I'm not sure this is for me. I was I understand all of our problems, but I don't know if this is for me, that I'm prepared to give up what I view as authority. I'm not sure I'm prepared to have people in a boardroom telling me what I need to do. I'm okay with the three of you guys who found the firm aggravating me, but I'm not sure that I'm looking for that kind of corporate culture. So there is important pushback by younger partners in firms that are in that 10 to 20 or 10 to $50 million range who don't get excited about the PE option. And I've been part of conversations where the firm, a $50 million firm, for example, with multiple offices, had a group of partners in one office who really had difficulty accepting this as an approach. It was a $4.5 million office. They allowed them to splinter off, and that $4.5 million office is doing well, and the $45 million office is now part of something else because it was the right thing to do, and the deal was healthy either way. So there's an example where it doesn't sail well for everybody. Now, that's at the partner group. The thing that is under scrutiny and needs more time to understand is, what about those managers and seniors? When they're now part of this PE consumption, are they happy with what happened, or are they exiting, and now this succession issue in 5 years is going to be a problem for the PE organization because they lost that core? And I will tell you that it's not infrequent that seniors and managers say, this is not what I bargained for. I don't want this. I'm happy to work for a big firm, but PE may not be that definition. There are some who love it, but the last statistic I read was it was 50-50 on how the staff, reacted and their stickiness after a PE-based transaction.
Wow. That's scary, right? I mean, scary, or, for some, they might be listening and saying, yeah, that's not surprising. But I mean, from the acquirer's perspective, flipping a coin on retaining key personnel is a huge,
it puts
huge
a lot
gamble.
of pressure on the acquirer to do that. And there's nothing wrong with that. The acquirer then is going to have to come to the table and prove themselves. And from their standpoint, they are offering a very lucrative future to these people. So, they've got to make it seem real and seem attainable. And I think they're getting better and better at it. And let's also be clear on this. There are two different types of PE players out there. There's a PE-infused CPA firm, like the Eisner Ampers and the Citrin Coopermans and the PKFs, etc., and the Aprios. And then there are the ones who are PE organizations rolling up CPA firms, and they have their own brand, etc., etc. Both have money. Both go about it differently, and the results may be very different. People who ended up with what I'll call the legendary CPA firm infused with capital might have been happier, or they might have been less happy. I think a lot of homework has to be done around this to really understand the consequences, and I'm sure that the HR people within these organizations are looking at it very closely, because while robotics and AI is really, essential and is only going to become more and more of a role, if you're going to push advisory services, it's not going to be one computer talking to another computer. It's going to be people talking. And you got to have those people to do it.
Yeah. If I'm going to throw an odd question at you as we wrap up here, but as it pertains to succession planning, if you had to put a billboard together for every accounting firm, partner, owner, leader to see, what would your one line, what would go up on your billboard, advice or warning around succession planning?
Start as early as possible. I think that when somebody has 2 to 3 years of experience, that's when you start to build a succession program. Shed your equity sooner than later. Doesn't mean all your equity, but start shedding it early in the equation. Make 55 look a bit more like 65. in your age and in your behavior pattern. Start it early. Show the confidence that you have and make it exciting. That's where I think this is all about, starting it early.
I love it. Yeah. I mean, just really, really reinforces if you got great talent, do everything you can to hold on to that talent. And you know what? I heard this great quote. If you're not sure, then you're sure. Right? If you don't think this is the right person, you're not 100% in on the right person, it's probably not the right person. But you may be like, oh, it's so painful to go out and find new people and to have that conversation with the existing one or try to level them up or level them out or whatever you need to do. So, but man, if you find the right one, changing, thinking of 55 like at 65 shouldn't feel like a huge sacrifice. And I'm just thinking of my own journey. I've had team members on performance reviews and they'll ask for this or that kind of raise. And it's such an internal struggle for me. And that's because I couldn't face the reality. It's like maybe they just weren't a great team member or maybe we didn't train them up well enough or whatever it may be. But it's like, and then I've had others that they'll ask for an atypically high increase, right? And it's like, we'll might do our stress test, of course, against, market perimeters and salary compensation. And then it's an easy yes. It's like, well, this is a no-brainer. Right. So I love that idea of starting early. And I feel like if you've got the talent, it's such a good use of your bandwidth, of your mental capacity, start thinking of this way. Ira, we covered a lot of ground. We spent a good bit of time on profitability, which was a lot of fun. In succession planning, of course, we talked about PE. I figure every interview, we either have one or two acronyms. We either say PE or AI. Right? One of those two are going to show up no matter what. There's all these two-letter acronyms. But if our audience wants to reach out, say thank you, learn more about your work, connect with you, what is the best way for them to do that?
Number one, you could reach me on my cell phone. I always enjoy conversation. 215-694-8084 is the cell phone I use the most. And my email address, ira@optimumstrategies.com. I love the profession. I was a practicing CPA and a managing partner. I think the future of the profession, even with all the aggravation, is phenomenal.
Absolutely. I think it's the golden age. Couldn't agree more. We're going to link everything up if you want to connect with Ira, and I highly encourage you to do so. It'll be linked up at jetpackworkflow.com/blog. That's jetpackworkflow.com/blog. Enjoy today's episode. Leave a review anywhere you could find a review us, leave it. And if you really enjoyed it, share it out, tag us if you put it out on socials. Ira, this has been a real treat. Thanks for coming on.
Thank you. You're terrific. Appreciate it.